Hello and welcome to Haman Nature. I am Adam Haman, and today I'm talking to Bob Murphy again, economist extraordinaire. And it's a good thing too, because we're going to talk about banking and clandestine sleuths in banking and economics, and how the CIA wants to take these heroes down. I'm speaking, in case you can't tell, about Richard Werner's appearance on Tucker Carlson recently. And Bob and fellow economist Jonathan Newman addressed the claims made by the good Dr. Werner on the Human Action podcast. I'll link to that. But Bob and I thought that the conversation really needed to be attacked from a few different angles and with more intensity, let's say. And so we do that here. I think it's fun, I think it's provocative, and I think you will love it. Hi, Bob.
Hey, Adam.
So what are we talking about this week?
Banks and the creation of money.
Banks are not in any economic model I've ever heard of, so, I mean, why would we?
You must be a fan of the Mercatus Center. So, folks, what we're talking about is more along the lines of Richard Werner, or Werner, was recently on Tucker Carlson's show, and I don't think we even need to play clips. Did we establish that?
I think so, yeah.
Don't worry, folks. We actually were contacted by attorneys from Tucker Carlson's show and cease and desist. That's a joke. So
it was the CIA.
Yeah. And anyway, there was a lot of interesting content in that discussion, but I told Adam there's just been a further fallout, and it's amazing to me the arguments on Twitter is where I see them. But this notion of the model of how do banks interact with the creation of money, and specifically on Tucker's show, Werner laid out three theories of how banks work, and he said there's the old school credit intermediary theory or loanable. Well, I don't want to say loanable funds theory. The credit intermediation one, where just households save, and then they give it to a bank who then decides who to lend it out to, and so the banks kind of are just the middlemen channeling the savings of the households to the borrowers, and that's one way of looking at it. In that framework, the banks don't create money. Another popular model, he said, is the fractional reserve model. That's what is associated with Austrian economics, by the way. So that's the one that if I had to pick, I would pick that one. And that's kind of like, oh yeah, somebody puts $1,000 in the bank, and then the bank takes 900 of it and lends it out to somebody else. So they only keep a fraction on reserve. And there's, that's one way of looking at it. And he says that's been discredited, though. The theory that he's propounding is the credit creation theory, where the bank just, somebody wants to borrow money, and the bank just marks up the guy's checking account. Says, oh yeah, you want to borrow $10,000? Boom, you've now got $10,000 in your checking account. It didn't come from anywhere. The bankers didn't go and check and say, well, how much excess reserves do we have? It didn't come from anywhere. They just created that money with the act of granting the loan. It's a bookkeeping operation. And so a lot of people on Twitter are saying, this is what it is. This old fractional reserve idea that you Austrians are clinging to has been, refuted both theoretically and empirically. Werner went to a bank and said, show me what you guys do mechanically when you grant a loan. And he documented it. And they do not take reserves from somewhere and give it to you. So anyway, so that's the idea. Yes.
Yeah, before we just blithely move past that, I want to say some quotes that Werner said. I'm just going to call him Werner. I don't know how you pronounce it, on Tucker, because he was presenting himself as some kind of a super ninja sleuth. He was figuring out the secrets that the powerful elites don't want to tell you. And he was literally saving economics from over 100 years of stagnation. He said, quote, macroeconomics has been unsuccessful. It's made no progress for over 100 years. And the reason is because of bank credit creation. It's a concept which we used to know, but it's been taboo, or a secret in economics. You use that word, taboo. But Werner, is going to resurrect the truth and present it to you people. Whether the CIA they'll try and stop him, but he's a hero. He's Indiana Jones, basically. and all the other mainstream economists and central banks that are Nazis. So you see what the good versus evil thing going on is here. He said literally, modern economic models don't work because they don't have banks in them, like they're trying to pull a fast one. If you ask any economist about the economy, they won't ever mention banks. That's another quote. And then he talked about the three competing theories that you just mentioned. And he believes, like he told Tucker, that Werner, is resurrecting the actual truth that banks create money, like no one had ever heard of this before. And naturally, he didn't mention the Austrian school. Never mentioned... well, like you said on the Human Action podcast, I mean, the Federal Reserve itself tells you that banks create money. So first of all, before we move on, I mean, like, I think this guy came off like a little bit of a con man. Am I off base in that theory?
Can I suggest? Let me just say what I want to get out of this episode for the listeners before I forget saying that, and then I totally want to get this and I just want to cater to your whims and answer your questions. So the way we framed it, folks, like beforehand when Adam were talking, is I said, I want just, you and I are going to have a conversation, Adam. We're going to get to the bottom of this stuff. But what I want to make sure we get across is that by the end of this, I may even quiz him. We'll have to see. I want you, Adam, to understand the sense in which, two things. A, what does it mean? There is a sense in which, yes, regular private commercial banks can create money in a way that like Tesla cannot. Right? So there is a sense in which Citibank has the power to create money, whereas General Motors and Tesla do not have that power. Okay, so there's that. However, I think a lot of the people who subscribe, fans of Werner and whatever, you see him running around on Twitter, I think they don't realize this, because then the second prong is private banks are not as powerful as the Federal Reserve, right? Sure. There is an important sense in which when the Fed creates money, that's a stronger claim than when we say Citibank can, right? So those are the things I just want to make sure, amongst everything else we get into, we get across. Okay, so back to your question. It's a little bit nuanced. It depends who he has in mind. So he's not setting up a straw man in terms of the average macroeconomist that, for example, Scott Sumner, and that's why earlier I made the crack about the Mercatus Center, because Scott Sumner is like, was their hero. I think he's, somewhat retired at this point. Was their go-to guide to explain the Great Recession and so on. And he said, it's because money was too tight, right? That was his novel. At first, people thought he was crazy, but then after a while, he won more and more people over, right? That he said, again, the crisis in 2008, 2009 was that Fed had the tightest monetary policy since the Hoover administration, right? So that's already, I think a lot of you are like, well, that sounds odd. But Sumner did not have banks in his model, and he was proud of that. In other words, he wasn't embarrassed that, if we included banks, that would make it harder to keep track of. And no, he said, that banks aren't necessary, because in his view, it was just nominal GDP. Keep that growing. He thought banks were an unnecessary complication that would distract from what really causes the business cycle. Okay, so Werner is not, like I say, setting up a straw man. There's lots. What's weird is recently, I forget which year it was, but like Diamond and Dybvig get the Nobel Prize for their work on explaining how banks do contribute to economic crises. So in 2022, Bernanke, this guy Douglas Diamond, and Philip Dybvig all won it, and it was for their work on explaining the role that banks play in financial crises. All right, so again, even there, notice it's a bit weird for Werner to come on Tucker and just to blank, to nakedly say economists don't have banks in their models, when a guy's 3 years ago literally won the Nobel Prize in economics for explaining how banks contribute to economic crises, right? So clearly what he's saying is not literally true, but it sort of underscores what he means, that they were so, after the great financial crisis, and then in the wake of that, and people studying saying, geez, what the heck happened there? And then, this Nobel Prize. I mean, I listened to interviews of, I don't know if it was Diamond or Dybvig, I'm getting mixed up, after they won, and they were talking to people, I don't mean from like NPR, I'm saying like financial press people that you would think would know this stuff. And we're just like, so when a bank, you put your money in there and you think that you have your checking account, but they go and give a 30-year mortgage to someone. And it was just blowing the guy's mind. And he was like reporter for Bloomberg, and I was like, "What the heck is going?" I'm not kidding. I was astonished. So it's, you know what I mean? Like, it's, I can understand why Werner is saying like, no, these people don't get it. Trust me. So so I know I'm going all over the place, but I'm trying to tell you it's a nuanced picture. And so here's where I'll end the comment with, when you're saying a con man. If Werner, like, by the way, I don't think I'm disclosing. Behind the scenes, like, I tried to contact, or I sent a message to him, and because he was following me, I guess because of the Mises thing, and I followed him back, and I sent him a message saying, hey, this guy Jonathan Newman and I, we kind of hit you a little bit hard on this thing, but I had a lot of my fans telling me that you and I really are similar in a lot of stuff, and I should have you on the show. I don't ambush people. If you want to come on my podcast talking about the Bob Murphy show. He didn't respond. I mean, for all I know, he didn't even see it. But then later, folks, the Ryan Griggs, who's my current PhD student, he tweeted out and said, wow, when your Tucker appearance gets panned by both George Selgin, Jonathan Newman, and Robert Murphy, you must be on thin ice, right? Because Selgin was hitting him hard too. And Werner came back and said something like, well, I'm used to dealing with controlled opposition, so it's not surprising that their work has such popularity, or something like that. Or their attacks on me are getting such credit. So finally, Adam, now I'm at long last ready to answer your question. If he had been sympathetic to other heterodox schools of thought and just said, yeah, a bunch of us are in the fringes. Oh, yes, the Austrians, they've been doing this, but they're out in the fringe as well. I'm talking about the orthodox mainstream at MIT and Harvard. That's what I meant on Tucker. I would be giving the guy a high five and say, oh, okay, right. Yeah, you're cool. But that's not what he did. It is, no, I alone am carrying this torch. And even though, like I was pointing to, I had a YouTube video that I did 10 years ago or plus about, going through all the stuff he was telling Tucker. And you would think from listening to him on Tucker that he was like, psst, psst, come here, let me show you the secret they don't want you to know. And it's, what are you talking about?
I have a series of short questions that might help lay some groundwork here, because like I said, the guy came across like a bit of a con man, at least in the sense of he's such a trailblazer and just got hidden truths. But there's a reason why fans of the Bob Murphy show, and Austrian economics might also had some things that this guy was saying that would resonate with them. For example, he was criticizing John Maynard Keynes quite a bit, and he was criticizing economists who use unrealistic models and tie themselves up in knots with them. So, but like from my perspective, he did that in a real clumsy way. But is there anything in there that we should applaud him for? Those specific, like, he doesn't like Keynes. Obviously, we like him for that, but
right.
It seemed like
but
muddled.
Again, but even there, it's funny because, like, I heard, I sent you Adam, like he had a back and forth with Steve Keen, and who's Keen? I mean, he's an iconoclast. It's hard to put him in a box, but I guess you'd call him a post-Keynesian, maybe, if you had to put a label on him. And they were going at, and even there, like, I actually agreed with Werner on a lot of the specific arguments. Like, for example, Werner was saying deficit spending per se does not create money, and Keen was arguing that yes, it does. And I on that one I agree with Werner that no, if the government just floats bonds and borrows money and then deficit spends it, that didn't create money. Just like if a corporation wants to spend more than it takes in revenue in a year, it can just float bonds, and what are you talking about, right? So, but yet even there, he came off just like real pompous, but also like overstepping and holding up, the insights and the uniqueness of his perspective. A different example, somebody wrote to Werner and said, yeah, how do you, what do you think of the MMT school? So as people who know me know, I don't like the MMTers. Werner came out and he was critical of them. So you'd think, yes. But he said he thinks that George Soros funded the popularity of MMT to take down Richard Werner's ideas, which is just, what are you, out of your mind? Yeah, so anyway, exactly. So that's kind of what I'm saying, is that he's a mixed bag, where even when I agree with him, the way he comes off, it's just like, what are you, insane?
Also, like he might agree with you with one specific claim. You see,
Right.
that's not true. But I'll tell you what I think is true, because it's the Earth is flat and we never.
Right.
So here's another dimension that I want to attack. It's the same question, but a different facet. Because in that interview with Tucker, he criticized the Fed and its creation as being a crony enterprise, and he made a bunch of noises about how we should favor decentralization in banking, and we're all about that. So, same question, should we applaud him for that, or is it? Because I know he does want these things regulated in some bizarre ways. So, like, how should we view his appeal to decentralization, which obviously we should support?
Right. Yeah. So let me again. I'll praise him and then take it away. I'll be a good economist and economist. And on the other hand, so my favorite segment of that interview, and Werner did a masterful job, and Tucker's mind was just blown. And he really did a good job. And that's what some people were hitting me. One guy flat out said to me, after I did the episode on human action with Jonathan Newman, folks responding when the Tucker thing first dropped. And, some people liked it, but a lot of others were saying, Bob, this guy, you guys were too curt with him. He really is a cool guy. And one guy actually said to me, Adam, he said, I did not understand that banks created money until I watched his stuff. I don't know if he meant that Tucker interview or he meant, earlier stuff. And he said, you can complain all you want about him, but I'm just saying he had a way of explaining it that it clicked with me. And I can understand that. And the way he was on the Tucker interview, he was talking about the goldsmiths and how, when someone borrows the money, they give them the bag of gold coins, but then say, oh, but as a condition, you got to deposit right back in the bank, and then we'll give you these notes. And the person's like, but I need the gold. He said, but the notes circulate in the community just as good as the gold coins, right? And then he said, do you see it? And Tucker was like, so the way he walked through that, I will concede, if Tucker had asked me that and I had 5 minutes to explain it, I would not have said it like as cleanly and like made it look like it was some kind of like riddle about a leprechaun in Ireland or something. The way he did it was awesome. So he does have a knack for explaining things and, inviting you in when really he's talking about double entry bookkeeping. That's kind of a scale thing.
I'm glad you said that. I thought he wove that story very intriguingly, very invitingly, but also he just layered it with a bunch of goofy stuff. Like, the system was shrouded in lies, which allowed the goldsmiths to engage in fraud because of the Christians' rule about usury. And then he said specifically that we invented, as a species, double entry bookkeeping in order to facilitate this fraud. I mean, I real quick asked Grok, where did it come from, when, and for what purpose? It didn't say anything about that. It's so merchants have a better understanding of their financial situation, and it gives them a mechanism with which to audit transactions. One thing has to balance against the other. It has nothing to do with committing fraud. I mean,
so even there, I think he would have been on more solid ground if he had said the use of double entry bookkeeping obscures the fraudulent or the dubious nature of fractional. Well, he wouldn't have said fractional, of credit creation when banks do that by having it be like, well, no, I mean, you see the liabilities and the assets go up by the same amount, so it all checks. It makes it look like it's solid and sound when he's saying no, there's got to be some inherent fraud there. So let me just go back to answer your question, because you said about the decentralization thing. Is that good? So he did a great job of showing Tucker something's weird. The guy goes into the banker's office with no gold coins, and then he walks out with a deposit slip that said, I just deposited 10 ounces of gold with the banker, and that's why I have these notes, and I can go around town and spend them.
And more specifically, nothing changed inside the goldsmith's vault.
Right.
Nothing.
In the vault, because again, folks, the guy, somebody else, other people, deposited a bunch of gold coins, so the gold, and the goldsmith gave them tickets, saying, yep, I had this amount on deposit at the goldsmith's vault, so they can go around town spending those tickets, and people just trade them because that's easier than going and getting the gold and then, redepositing it. Just the tickets circulate as good as gold, as long as the guy's trustworthy and you can't counterfeit them. Okay. And then somebody shows up and says, I want to borrow 10 coins worth of gold. And he says, okay. And so they write up the IOU with the terms and the repayment and the interest rate and blah, blah, blah. And then he says, okay, here's your bag of 10 gold coins. Oh, wait, but one of the stipulations in the contract, the loan contract, is you need to keep your coins on deposit at my bank. And the guy says, but the whole point of the loan is I got to go spend it. And he goes, yeah, that's fine. But here's the notes. Give me those back. Puts them in. You deposited. Yep. So the bearer of this note has 10 gold coins that are now in deposit at this goldsmith's place. Go spend these. These are as good as money in the community. And so the guy leaves. And like Adam just said, folks, no gold left the vault there.
Right.
But everybody else who deposited it beforehand still thinks, quote, their gold is sitting in the vault. And it kind of is. But now this guy is walking into town with 10 new tickets. Right. And so
Tucker
that's
was real
fraudulent. Yeah. And so blowing Tucker's mind. But I mean, again, this is all stuff like Murray Rothbard people's. And like Adam said, we also showed in the Human Action episode, it's not just like, oh, if you read Rothbard, the Federal Reserve in the 60s published a manual walking through all this stuff. It even explained it. Oh, yes, it goes back to the goldsmiths, right? So they didn't call it fraudulent, the Fed, but they explained this process. So anyway, just real quick, Adam. So to answer your question, though, so in terms of the decentralization, later on, when Tucker's asking, well, what do you think should happen? You might think that he would say, well, since I just established to you that per se it's fraud when they do this, that needs to come to an end. I mean, that's Rothbard's conclusion. He says in a free society with libertarian judges, you wouldn't be allowed to do that. That if it's a demand deposit, like, quote, a checking account, they got to keep it there. Just like when you check your coat at a restaurant, they can't lend it out to homeless people as long as they get it back in time before you show up. No, that you can't do that, right? So you might think that's what he did, but no, he didn't say that. He said, oh, as long as the banks engage in loans, credit creation for genuine productive business purposes, that's healthy. And so we wanted to break the power down from the central bank and give it to all the small banks that got their feet on the ground. They're out in the community and they can sense that, oh yeah, that hardware store needs a loan, and that's nutty to me.
Yeah, I definitely want to dive into that weird prescription of his and how you'd enforce it and how you would define it and all that other stuff. But before we do, I thought it was great, like the way he laid that story out about how the money was created with the goldsmith. Really blew Tucker away, and it was kind of funny. He thought he had a zinger. It's like, yes, it's alchemy, Tucker. It's like modern day alchemy. And Tucker just sat there and frowned at him. That one didn't land. But I did want to ask you again. I kind of want to tear this.
Can I stop? Do you think it was because he just didn't get the joke, or he thought he didn't realize it was a joke?
I don't. I couldn't figure out. Maybe he didn't hear him, or he was thinking about something else, or he doesn't know what alchemy means. I couldn't figure it out. I don't know. So yeah, I want to tear this guy apart because he came off real obnoxious to me in a way that was just not deserving. But he also said, this is my last point of trying to give him some credit. He was talking about the client money rule and how banks are exempt and how that rule came from England, the birthplace of banking. And it is like in every other business enterprise, when you have funds from a client or from anybody else, you have to keep that separate. There's regulations all over the place. Mm-hmm. And obviously that's not the case with banks, or they wouldn't be able to engage in the fraud you just described. So I wanted to ask you, do you think that's a correct way of framing the question? Did he get that right, or did he miss the mark?
If you had asked me in a vacuum, not referring to that thing, there's no way I ever would have volunteered the phrase the client money rule. What I would say, though, is that, yeah, there were famous rulings in England, and it goes back, the definitive source on this stuff is Huerto de Soto's, what is it, Money, Banking, and Business Cycles, or something like that, on this stuff, where he goes back to, like, ancient Roman law, and just shows through the distinction is between what's called a bailment contract and a loan contract. So a bailment is when you deposit something and the people are holding it like for safekeeping or storage, and it can be fungible, like a grain elevator, right? You go and you deposit your grain there, and they put it in the thing, and they give you a ticket. And when you go back later, it's not that you want literally the same bushel or whatever the unit is, but at the same time, like the nature of that is that they have it, they're not lending it out. And then if too many people showed up, there wouldn't be enough to go around, right? That's just the nature of that. And so, yeah, there were cases, famous cases where people sued bankers and whatever. And then it came down. And then I think that came over with the colonists from England, like this principle that said, yeah, when you deposit your money to a bank or into a bank or give it to them, that technically the way that's legally being treated is you are loaning them the money. It's not that you're saying, hey, hang on to this for safekeeping because, I don't want to be walking around $10,000 in cash on me. You've got these big vaults and armed guards and ATMs and all this system of checks and whatever. It'd be kind of more convenient for me. So why don't you hang on to my money? They say, no, that's not what it is. You're making a short-term callable loan. And so that's why they can do whatever they want with it. They owe it to you, right? It's not that they don't owe it to you and, that you just made a gift to them. But the idea is you lent it to them, so they're free to do whatever they want with it. And then, if you show up and want it and they can't give it to you, that's just equivalent. That's not fraud. That's just like, if some business issues bonds and they want to build a factory because they think there's going to be demand in the next quarter and they just guess wrong and they go out of business, they owe the creditors the money and that's too bad and there's bankruptcy and blah, blah, blah. But no one says they engaged in fraud. It's like, no, you just entrepreneurial misjudgment. So that's the way I would explain it, and that's what Rothbard thinks that's fraudulent, DeSoto thinks that's fraudulent, Guido Hulsman, and so on, and so does Werner.
Yeah, and so do I. Two interesting quick anecdotes. I think they still call it the client money rule. If you go take like a test, class for a test to get a real estate license or something, or property management, they drill it into your head how you have to keep your client's money separate, for all the obvious reasons. And then when the online poker business was booming and all those unregulated casinos were doing so great, and then the government came and shut them down, one of the big players, I don't really want to mention who, one of the big things that they got in trouble for was they were engaged in a little bit of this practice too. They, the customers send them their money and then they get electronic, quote unquote chips to play. Mm-hmm. So they've got all this money and they know everyone's not going to ask for it back all at once. So they're like, right. Oh, well, hey, why don't we? So they ended up doing a whole bunch of nefarious stuff, like investing in, I think, movie scripts and production even. And then if the government had never cracked down, thanks to the, the cronyism of the established casinos here in Vegas who put the pressure on the regulators. If that had never happened, they probably would have gotten away with it because I bet they were being relatively conservative in their fraud. Mm-hmm. I bet they knew how much they needed to satisfy customers.
Look at this script. This is funny.
Yeah, exactly.
We get the right person cast in this role. This thing's going to make it
can't miss. We'll turn this over in a couple of years. So do you want to move on to Werner's survey that he did in Frankfurt, or do you want to go in a different direction?
However you want to take this.
Okay, well, one of the bombshell moments when he was talking to Tucker is he said, I used to teach a huge class in Frankfurt, Germany, and so I enlisted the aid of the students. They went out into the center of town and got a huge number of respondents for this survey because I don't think anybody knows about, where money comes from because of this big lie that's being wool pulled over their eyes. So he had this one question survey, and it is, quote, who do you think creates and allocates the majority of the money supply in the economy? And it's multiple choice: the government, the central bank, the financial markets, the banks, people through their savings, and I think he said he gave a couple other options. And 84% of the respondents said the government or the central bank, and he was mocking them for their stupidity. And that struck me as a little odd because we do know that central banks do create a bunch of money, more or less, depending on what shenanigans are going on. But then, as you said to me, he did put that weasel word in there, allocates the majority of. Mm-hmm. So I guess in the case of normal operations, quote unquote, it is private banks that create most of the money in society. Is that the...
Yeah, and it depends. So, okay, I'll try to keep this concise because this is the heart of it. And this is one thing, folks, that after Jonathan and I did our response on the Human Action podcast, I asked Adam his thoughts, and him asking about the survey, I realized that we kind of assumed people knew this stuff, even like people that were in Austrian economics, and realized that okay, this is, I guess, subtle. So it depends what you mean by money and what is true. Let's just use the United States. That's most familiar to people. So there's the narrowest definition of money is what you could call base money. So like actual green pieces of paper, Andrew Jackson, Benjamin Franklin, and technically, if you look at it, think, what is that? It's a Federal Reserve note. That's what it actually says on it, right? So right there, that's interesting. It's not just, dollars printed by the Treasury or the U.S. Mint. They're actually banknotes from the central bank. Okay, so there's that. What's legally and hence economically equivalent to those is when you're a regular commercial bank like Citibank or whatever, Bank of America, they have what's called a reserve account with the Fed. Okay, so Citibank can have whatever, $100 million in its reserve account. Think of it like Citibank has a checking account with the Fed. And that's electronic, right? Those things. But if Citibank wants, like let's say it's got $100 million in that reserve account with the Fed, and let's say a bunch of people are withdrawing money from the Citibank ATMs around the country, and so their cash is getting low, Citibank can just say to the Fed, hey, we need $20 million of currency. And then the Fed can have that printed and send it to them. And then, Citibank's, checking account balance goes down by 20. So now they only have 80 million, right? So that's what I'm saying, that when the regular commercial banks have reserve accounts with the Fed, that is just as good as having green pieces of paper with, dead guys printed out of them. However, you might say, oh, so that's it, right? And that's kind of what people think of when they think who's in charge of the dollars. It's the U.S. government. Well, they know the Fed's kind of involved, but that's, those two entities put together, clearly they think that's who issues U.S. dollars, right? And yes, if what you mean is what I just said, like the green pieces of paper and the things that are equivalent to them that you can just on command have turned into it. But there's a broader sense, which is like, instead of calling it just the base money and reserves, instead you can say like M1, that stands for, monetary aggregates. M1 is, and that includes the paper currency that, might be in your wallet or, in some lady's purse, but it also includes checking account balances at regular banks. And so this is the last thing I'll say on this, is that because of fractional reserve banking, that number, M1 can be bigger than the original base amount, right? If there were 100% reserve banking, the two would just be interchangeable, right? If you had $1,000 in currency, you had 10 Benjamin Franklins in your wallet, and you went to Citibank and said, here you go, put it in my checking account. If they had to just keep that in the vault, and now, your checking account balance went up by 1,000, that wouldn't create money, right? But what happens is now if they grant a loan to somebody else for 900, that person's got 900 now, he thinks, in his checking account. You still think you got your 1,000, even though there's only 1,000 sitting in the vault in green pieces of paper. So that's the sense in which Citibank's decision to grant a loan to somebody genuinely increased the money stock. If by the money stock you mean regular balances with, standard banks. Okay, so that's what he means. And I was just looking at the statistics for the U.S. It gets screwed up after 2008 with all the QE and stuff because the Fed created a bunch of reserves that are just, the system's kind of like stuffed with reserves now. But in normal times before 2008, it bounced around. But you could argue, if you're using M1 and you're saying, what does M1 look like compared to the amount of green pieces of paper in circulation and banks' reserves on deposit with the Fed, M1 typically was about twice that, right? So in other words, you could argue, I wouldn't say it was the overwhelming majority, but you could argue that the majority was created by private banks in conventional times before 2008. I think that's a fair statement.
I'm very glad you laid it out completely that way, because Werner also, he poo-pooed not only the central bank, but he also poo-pooed the fractional reserve system.
Right.
Instead saying, just forget fractional reserve and all those implications. Just private banks are the ones who issue most of the money. Is he making any kind of an error there, or?
Yeah. So here, and again, and this is the thing, it's just the people arguing on Twitter. I get it, how, people like to argue too. So both sides are making true statements. In prima facie, it looks like they're contradicting what the other people are saying. And so they're like, well, since I know what I'm saying is true, and it looks like what this guy over here is saying is not true, then he's an idiot or a liar. And it's actually their framework is different, right? So they're both correct given what they're trying to say. And so if that's true, then they're actually not contradicting each other, right? Because they can't both be true if they're contradicting each other. So here's what's going on. The way textbooks used to treat this stuff, and I'm sure I taught this when I was at Hillsdale, is you say, oh, let's just let's say that there's a reserve requirement that the authorities impose on the private banks. Somebody puts $1,000 in their checking account, the bank goes and puts $1,000 in the vault, but then they don't need you just to keep the $1,000 in there, right? That would be 100% reserve banking, but we don't have that. We have fractional reserve banking, and then for the purposes of going through the example and doing the arithmetic, and because historically in the U.S. the authorities really did impose reserve requirements, they said to the banks, yeah, you don't need to keep it all in the vault. You're allowed to lend it out, but you can't lend all of it out at any given time. And they had, the rules were nuanced or whatever, but as a rule of thumb, it was a good approximation. And this is what the textbooks usually would just do for the example, is say the authorities insist the private banks at any given time, if you add up all the checking account balances of their customers, there better be 10% held in reserve, either as currency in the vault, or you can have that on deposit as reserves with the Fed. Right? So if Citibank's customers have $1 billion in checking accounts total, right? Every single person's got a Citibank checking account. If you added up all their numbers, if you asked each person, how much do you think is in your checking right now? Right? They all answered, you added up those, and it was $1 billion. Then Citibank needs to have, if there's a 10% reserve requirement, needs to have $100 million in reserve, and that can be satisfied either by currency in their vaults, their various branches, or if they have it electronically with the Fed. Those two numbers added have to be at least $100 million. Okay, and so then the way this framework plays out is they say, oh, and so if the Fed wants to loosen, they buy assets that pumps reserves into the system. Now people have more currency, let's say, or reserves with the Fed. They go into, some guy deposits $100,000 into his checking account. Now the private banks have that much more in reserve, and they can lend out 90% of it, right? Because the 10% reserve, so any new deposit, you got to take 10% and put it in the vault, but that leaves 90% that you can lend out. And so then they go through it like this, and they say, oh, so somebody puts in $1,000 into his checking account, they take 100 and put it in the vault, they lend out 900 to the next guy. What does he do with it? He spends it somewhere. That merchant gets it, goes and puts it in his bank. But from that bank's point of view, they're not looking at it as like, oh, this is the remnant or the child of a previous. No, they just say, oh, I just got a $900 deposit. So what do? They take 90, because we're at 10%, and put it in the vault, and they lend 810 to somebody else. And so then you run through that, and then the infinite limit of the sequence, that process stops where all of that original 1,000 now is part of the 10% reserves, and so that's supporting $10,000 in total new checking deposits, right? So the original 1,000 in reserves leads to 9,000 in the creation of new loans, new checking accounts, balances, right? So that's the way that story was told. Like, again, I'm sure I taught that at some version. And Werner is right when he says, no, that is just empirically, that's not how banks work. So that's correct. He's right when he says that, because he said just even at step one there, some guy puts in $1,000 into his checking account, he leaves, he thinks, yep, I looked at my balance, it went up by $1,000. I can see it right here on this piece of paper. They gave me the deposit slip. And then if some other guy comes in and the bank wants to lend him 900, Werner's point is they don't take that out of the vault and give it to him. Right. They just mark up his thing. And also, if that guy wants to borrow 1,200, they don't say, oh, shoot, we can only lend you 900. So they're saying when the banks are making these credit decisions, granting loans to people, they're not running and saying, hey, what do we have in excess reserves right now? That's their point. And they're right. Like, I've talked to a banker, who's well steeped in the Austrian tradition, and he told me, he said, yeah, I've never been, he said, when we're at loan meetings like that, nobody ever asks what are excess reserves.
It makes me laugh just to mention it.
Yeah. So that's true. Last thing I'll say, Adam, is if that were the whole story, then yeah. But when people talk like that, they make it sound like the banks are, can just create money willy-nilly. And they can create money. So there's no check on them, and they don't care about the reserves, right? Some of them will even go so far as to say, "Oh, you guys are reversing the cause and effect by granting the loan to someone. Now, when he goes and spends that's a deposit somewhere else. So it's not that you need the deposit in order to then get reserves, then make loans. It's the other way around. That when the banks grant loans, they create the very funds that are then deposited elsewhere, right? And I'm saying, well, no, if that were the whole story, then how come all the bankers aren't quadrillionaires?
Exactly.
Right? They could just make loans to each other and then never call them, right? And so clearly something's not quite right, and what they're missing is the reserves do come into play. So yeah, that original story I told is not quite right. It's a simplification, but the reason it has to happen in a stepwise fashion, and it can't just be when the first guy puts in 1,000. I mean, think of it this way. Even if there were a 10% reserve requirement that the authorities imposed, the first guy puts in 1,000, and normally the story goes, oh, they lend out 900. They could go grant a loan to someone for $9,000, right? Just do the math. The first guy puts in 1,000. His checking account says he's got 1,000. If they grant a loan to some other guy for 9,000, at that moment, the total checking account balance is added up to 10,000, and they've got 1,000 sitting in the vault. So they would be good. Nope, 10% reserve requirement. The reason that would be reckless and stupid is because the reason the guy takes out a loan for 9,000 isn't just to have it sitting in his checking account forever. It's because he's going to go spend at least some of it. And here's the trick. If he just spent it on other Citibank customers, it would be okay. It would just transfer from his checking, his checking account would get debited and theirs would get credited, and Citibank would still be fine. But the moment he spends it on somebody who's not a Citibank customer, somebody who's a Bank of America customer, now at the end of the period, like let's say it's a week, Bank of America and Citibank settle up with each other. And they say, oh, your customers had $3.7 billion in claims against ours, and we had 3.6 against yours. So we need $100 million to settle up. And the bank that's short has to send reserves over to the other bank. And so, they could just debit their reserve account with the Fed and credit the other one, where they could literally send vault cash, in armored cars. So that's why it would be reckless for the bank, when the guy puts in 1,000, for them just to grant a $9,000 loan to someone, is because their vault would be empty really fast if they did that. So that's why they don't do that.
Gotcha. All right, one more quick question before we pivot. Correct me if I'm wrong, but didn't the government recently completely remove the reserve requirements, take it down to zero? And
right.
I would have thought that would be kind of a big deal, but as the years have gone by, now I'm thinking maybe it doesn't matter that much. What's your opinion?
Right. So, yes, in 2020, right, I think it was in March, right when we were just about to tip over into total COVID panic lockdown mode, it was on a Sunday night. And it wasn't even, it was like the Fed, made some announcement, some press release on a Sunday. And then it wasn't even in that announcement. Like, you had to go in the footnotes and then go click onto something else. Like, it said, this is all spelled out in this addendum. Or it might not have been called an addendum, but I'm just saying it wasn't even the original thing. You had to go and then go to some secondary thing. And that's where it elaborated and said, among the other changes that we're making now, reserve requirements are no longer a thing. And they, so yeah, that's what they did there. That again, before it wasn't literally 10%. There was like different things depending on accounts, blah blah blah. But yeah, they just totally got rid of reserve requirements formally. There's still like capital constraints and there's other types of regulations that banks can't just go, put it on the horses. But yes, the official reserve requirements were eliminated. And the thing is, at that moment though, it didn't matter because they weren't binding, right? Because again, after 2008. With all the rounds of quantitative easing, the Fed bought a bunch of mortgage-backed securities and treasuries. And so when the Fed buys assets, its money is by definition reserves, right? When the Fed writes a check and then, you go deposit it, whatever bank that lands in, that bank now, if you just think about it, it's not that, we got a check drawn on Citibank, so we go to Citibank and say, give us some of your reserves. No, if it's the Federal Reserve that's buying the bonds from some guy, and he puts the check into his checking account, let's say it's Citibank, they say, you got a check here for $100,000. Who's it from? It's written on the Federal Reserve Bank of New York. Okay, so we're going to credit your checking account, Jim Smith, $100,000, and then we go to the Federal Reserve Bank of New York and say, we Citibank now are presenting this check, so you increase our reserve account with you by 100,000. So when the Fed did all those rounds of QE, the reserves went way up, and then the private banks were not granting a lot of new loans to their customers. So the banks, actually, the reserve ratios were well up. They were over 100%. Right. In other words, the private banks after 2008 had more in reserve than they needed to back up their checking accounts, and so
they're also getting paid.
Right. That's partly why. Right, because they October of 2008 is when the Fed started paying interest on reserves. As I summarize it, the Fed started paying banks to not make loans. So that's partly why, Adam, people didn't freak out when they got rid of that reserve requirement in 2020. It wasn't binding at that point. In other words, the banks were already keeping way more in reserve than what the rule had insisted was the floor. And so by getting rid of the floor when they were already, you get what I mean? It's not like it opened the floodgates. They're like, yeah, we didn't want to have reserves that low anyway. So I think that's partly why people didn't freak out.
Let me give you a visual to explain my intuition. You can tell me how off base that is. The reason I'm not freaking out is because I feel like we've been Wile E. Coyote after running off the cliff for quite some time now, and now our legs are just pumping in midair, supported by nothing. And so this change that happened in 2020 about the reserve requirements is like, who cares?
Yeah, I think that's true. Also, even before the Fed, well, let me just back up. So you can see that was another trump card that the pro-Werner people, the credit creation people, think that the fractional reserve story is stupid. That was a trump card they would play. As they say, guys, you guys were wrong in the 1970s, but you're really wrong right now because there are no reserve requirements, you dolts. So you can't even, your story starts out at step one with, well, the Fed, the authorities impose a 10% reserve requirement, so that's why the banks operate like this. And they're saying, well, no, right now it's 0%. So even according to your own story, somebody deposits $1,000 and they should go and lend $1,000 to somebody else, right? Or infinite, really. And actually, that's maybe my way of coming back and say, well, no, it can't be what you're saying, because why don't they lend infinite loans then, right? Because if there's no reserve requirement, you can just do whatever you want, right? And so clearly, no, there's something else going on. Also, though, I forget which, it might have been in Australia, I can't remember. Before the Fed did that in 2020 for U.S. banks, there were other jurisdictions that also had no reserve requirements. You know what I mean? So even like when we would argue with this stuff, whatever, in 2006, and I would be making my points where the people would say, you idiots, don't you know in these countries over here, they have zero reserve requirements right now, you idiots. So I'm saying that was a thing.
Okay, cool enough. I'm done being nice to this guy.
Uh-oh.
Because with this one, he really chapped my hide. He said to Tucker, I was the first person to ever do an empirical test of the three theories of banking that he was just describing, money creation, to determine which one is true. By which he means that empirical thing where you get a film crew and you go out to a bank and you get a loan and then you get your empirical scientist camera operator to follow the guy around and see which debits get credited and credits get debited. And maybe I was not doing that well in school, but that doesn't strike me as particularly empirical in this context. What say you?
Well, if it is empirical, it also is consistent with the fractional reserve theory.
Sure.
You know what I mean? So it's that's kind of, again, the way that his demonstration, the way you would have to define what the fractional reserve model says versus his credit creation model, you didn't need the film crew to prove that. You know what I mean? Like, in other words, you say, oh, if what you meant by the fractional reserve model is such and such, yeah, you don't need to go test it. I agree with you. That's wrong.
Bob, without a film crew, how are you going to know what these bankers are doing? I mean, honestly.
Yeah.
Didn't James O'Keefe teach us anything?
So the other thing too is I was saying to Jonathan, I'm being a bit cheeky, whatever. And again, it's just because he's so full of himself and everywhere looks around and says, yeah, these people are out to get me and whatever, but they won't succeed. The truth is on my side. So that's probably why I'm being so cheeky with the guy. But it is true that, for example, nobody told me that the banks just create money, right? Like, I kind of had to figure that out myself. And so And me just working through the logic of that fractional reserve story, I realized at some point that it's, even if you just analyze it on its own terms, and you say, okay, so again, I was working with that same example. Alice comes into the bank, puts $1,000 in currency into her checking account. She walks out with the slip saying, "Yep, your checking account just went up by 1,000." So she thinks she's got $1,000 extra in her checking. And then let's assume, there's a 10% reserve requirement, so they can only lend up to 900, but they want to. So then Bob comes in and he gets the loan of 900. And if the way you normally would tell the story is they go to the vault and they take the 900 out and hand it over to Bob, and then he leaves. And so, see, Alice still thinks she has 1,000, and now Bob's walking around town with 900 in currency. Still, though, they didn't hand the currency to Bob and then grant him the loan. They granted him the loan first.
Right.
You see? And so I'm saying
right.
Technically before they handed him the money, if they marked up his checking account and then he just withdrew it 2 seconds later, I'm saying if you tried to isolate, you say, okay, so we all agree that there's a sense in which the bank, by doing this, gives Bob $900 and that adds 900 to the economy. You say, when did that happen? It's clearly not when they took it out of the vault and handed it over to him. It's when they granted the loan.
You make a good point. In the late 80s, as they were teaching this stuff to me in Arizona State University, I'm pretty sure they described banks as these intermediaries, harmless, just a pass-through. And then they described the Federal Reserve cycle, and they never actually mentioned, the truth of this. I mean, I figured out as soon as I started visiting Mises.org and listening to people like you and reading Rothbard and all like that. I'm still annoyed about this empiricism crap, because when he was talking to Tucker...
Sorry, let me just make sure I know you got it, but for the people... So my point there is, even if you were firmly ensconced, is that the word I want? Embedded in the fractional reserve model, and you said, okay, you agree, and part of your... Especially if you're a Rothbardian and you're against it, you say, this is fraudulent. It's like... multiple people have this claims on the same money that can't be and you definitely would say the banks in a sense are creating money, and you just think that's illegitimate. Like, how can they do that? Because there's not genuine saving, right? The households haven't saved $1,900. They've only saved 1,000. So why, how could that be? That I'm saying, if you just think it through and you say, like, when is it, like, I think you would have to realize that, it's the act of granting the loan. And especially if you go through the bookkeeping and the double entry accounting, you'd say, when the bank grants the loan, its assets go up by the 900 and its liabilities go up by the 900. It has to, right? To make the books balance. And that 900 liability is by, increasing the checking account balance of the guy. And then if he wants to withdraw it, he can. And then it draws down the liability and draws down the assets of the vault cash by 900. So, my point is just that I think even on its own terms, if you pushed it, somebody in the fractional reserve school would have to agree that, yes, banks create money through granting of credit. And yet Werner's trying to say, like, that's a categorically different, that's door number 3. Like, it's either fractional reserve banking or it's banks credit creation, ex nihilo, which one? And I'm saying they're both ways of describing the same thing.
Right. So to Tucker, he is portraying himself, Werner is, as the lone empirical economist out there in the world righting all wrongs. But usually when he'd refer to these things, he would talk about some sort of regression analysis or something, which I view highly skeptically, because, correlation, causation, you can't figure out which variables are truly relevant. You can't isolate completely. And then he said one other thing that I just had to ask you about. He says it's just not true. It has never been empirically tested. It's just an axiom when people say that lowering interest rates stimulates an economy and that raising interest rates suppresses an economy. It says nowhere in the history of man has any empirical research on this just assumed truth ever been done. And I just was wondering what you think about all of those claims.
Okay. On his empirical stuff, like he had a few accounts on Twitter, and one of them is something like @scientificecon. Right. And that's like I got a blue check, you know what I mean? So in other words, like he really is proud of himself that
he's paying for
I'm
that
being
one.
the one. Yeah, I'm being the one that's empirical here. So, okay, even here, even on his own terms, this is not something new. This Milton Friedman has a famous quote about this that Scott Sumner loves, and this is partly why I remember earlier I said Scott Sumner originally gained notoriety and then eventual respect and homage for saying that, oh yeah, the reason we had the great financial crisis is because the Fed and other central banks were too tight in 2008 and 2009. People are like, what? I said, but look how low interest rates were. They cut interest rates to zero. And Sumner's point was, yeah, that doesn't mean that they have loose money. Why would you think that? And then he dug up this quote from Milton Friedman. I'm going to paraphrase something like, empirically, low interest rates tend to be associated with a period of tight monetary policy, whereas high interest rates tend to be associated with prior periods of loose monetary policy. And so just think about it. Let's say, especially like if you're a Milton Friedmanite monetarist, what do you think caused the Great Depression? It's that, the money stock collapsed by a third from 1929 to 33 because people were, taking their money out of the banks, and there were bank runs and banks were going down by the thousands. So that the bank credit creation process that we just walked through earlier was happening in reverse. So the money stock was shrinking, prices were collapsing, and among other things, interest rates can come down in an environment like that, right? If prices are falling, you don't need to have, you can afford to lend out 100 and only get back 101 next year because prices are going to come way down, right? So you don't need a huge. So that's the sense in which if there has been devastatingly tight money that's causing a depression, Friedman's point was, would you expect interest rates to be really high or really low in that environment? It'd be really low. On the other hand, if you're looking at a country that's in a hyperinflation, interest rates are probably like 500%, even if the central bank is, running the printing press constantly. That's just, you get what I'm saying? So, because, if price inflation is 2,000%, the fact that interest rates are 500 or whatever I said, that still real interest rates are quite low, negative, right? So there's a quote there. So I think, Werner could have something in mind, although he can't say it's never been empirically. He could just, there's that element. Having said all of that, what the causal mechanism is, though, is that, if you're in an original equilibrium and then a central bank wants to pump in a bunch of money, or even if the regular commercial banks decide to just make new loans without, more saving, interest rates have to be lower in order to induce a higher volume of loans. And then that stimulates, an unsustainable boom in the Austrian framework. So money creation, again, if you're in an original equilibrium and then there's money creation, whether it's from the central bank or the private banks that gets into the market via lending, that's going to tend to push down interest rates. So there's that sense in which that influx of new money, which would tend to, juice conventional metrics, would be associated with something pushing down interest rates, and vice versa too. It's not wrong when people say, what did Paul Volcker do when he comes in the late 70s? Inflation's out of hand. What does he do? He slammed on the brakes on money creation, and that made interest rates soar, and then that got inflation under control, and that crashed the economy, right? So that's I can run a regression analysis on that, and you would definitely find, or recently when Powell, quote, raised interest rates, that's what got price inflation under control, right? So we have lots of examples of that working. So
would have been nice if the scientist at any point in there had said, of course it is completely unstable to artificially be pushing up or down interest rates. That's a thing that a market should do.
Yeah. You know what else a market should do?
Do tell.
It should allow somebody, if they have some kind of corporate logo or their church is going to have a festival or something, you say, I would like to get my organization's name or logo on a bunch of merchandise. I guess that probably doesn't exist, right? Because there's a market failure.
I think that's a magnificent idea, and I have heard of such a company. It's called the Swan Brothers, and what they do is pretty amazing. They will help you set up a merch store, an online merch store, and enable you to create products that you can use to give to your employees or use it to fundraise for your organization. And what's the best thing about it, Bob, the Swan Brothers, is that you don't have the slightest idea what you're doing. All you have to do is have the sense that maybe one of the smartest ways people have been advertising for decades now is putting logos on merch and swag so that, like when you buy a radio ad, that's just gone after the radio stops playing it, right? But this merch lasts forever. And I have a completely unverified statistic here that says that 83% of consumers are more likely to buy after receiving a promo item. All those lawyers and dentists can't be wrong with those pens, right?
Yeah, and it's not just pens. There's hats.
It's not just pens. That's right.
There's windbreakers. There's tote bags. All sorts of things. Coffee mugs. The is it a koozie? Am I saying it right?
I think so.
The thing, yeah. So all sorts of stuff, folks, that you can get your
Cozy?
logo on. What?
Cozy? Koozie?
I don't know. I say koozie.
I like to say jacuzzi. The Swan Brothers, legitimately, ladies and gentlemen, is just one of the best organizations in this space. They give you the white glove service. If you just provide them with a logo, they'll get everything set up that you'll ever need. In fact, if you don't have a logo, they'll help you with that. That's not a problem. As they say, or like to say, a more inclusive soup to nuts handheld service in this space, this merch space, does not exist. And again, it is a pretty smart way to spend advertising money. The run just never runs out. This merch just lives forever. If your employees are walking down the street with a windbreaker with your logo on the back and a catchphrase or a web address or URL, it just goes on and on and on. And this company is great. I attest firsthand that the quality of the products is really, really, really good. Can't recommend them enough. What's that URL, Bob?
It is theswanbrothers.com/cross, because they're the sponsors of these crossover episodes. So once again, folks, theswanbrothers.com/cross. Go check them out.
Fabulous. All right, going back to Dr. Werner. Here's another quote, and it's a doozy, and it alludes to something you were bringing up earlier. Quote, "Banking crises happen because banks are lending money for asset purchases, and this causes the boom-bust cycle." He also says it's bad for banks to lend for the purpose of consumption. And in your Human Action podcast with Jonathan Newman, you guys attacked this, but it was kind of technical and academic and a little bit laborious, and I think you just need to take a flamethrower to this thing.
You saying we were boring? It sounds to me.
No, I'm saying you were erudite. I only brought any of that up is because you said it didn't land with everybody.
Yeah.
So what the heck? How could such a thing... he says he wants decentralized banking, but this is an insane rule. And how exactly is it going to prevent the boom-bust cycle? Because isn't that lending for commercial purposes that causes that?
Well, yeah, and just to round it out, he said the two things you said, that if they lend for, to fuel asset purchases, bad, fuel consumption, bad. But if they lend to allow business investment, that's good. And that's what he wants to encourage. And in fact, Deng Xiaoping went over to Japan, and that's what they told him. And so he said, oh, okay. And
he didn't underscore it, but obviously he's just been telling us how fraudulent this mechanism is.
Right.
But now the fraud is good?
Right. So that was the joke, folks, that I made to Jonathan. I said, so apparently fraud is good if it's channeled into these avenues. So, right. What's interesting, so I have no problem with him saying if banks are engaged in fractions or credit creation, lending out money that doesn't exist before the loan's made, with various ways of describing it. And then people take that new money and go and buy stocks or homes with it for speculative purposes, that's going to generate a boom bust cycle. I got no problem with that. That's totally consistent with Austrian business cycle theory. Just fueling consumption, actually, to me, that would be the most innocuous of the three in terms of not fueling a boom bust cycle. Okay.
Right.
But not that it's good, but
right.
But lending to business, I mean, that is the essence of the standard canonical, old school, original Misesian theory of what drives the trade cycle, is that, interest rates serve a function, and that in a normal economy, right, if the households save, right, they live below their means, so they don't go out, they don't spend as much on consumption, that frees up real resources, right, that you're not going to the diner as much, you're not going to the movie theaters as much or whatever, so whether they literally close down the diners and the theaters or just means new locations don't open that otherwise would have because the public's not spending as much. Still, real physical resources are freed up and they can get channeled into investment projects. And how does that actually happen financially? How does the economy know what to do? And in the Austrian framework, the idea is, when the households save more, maybe they deposit it with the banks or they give it to some other, middleman in a pure financial intermediary capacity. Interest rates come down because there's more saving, and then business people run the numbers and they say, this lower discount rate, this long-term project makes sense now. It's profitable because I got to do some upfront investment, and then the revenues come in down the road, and at a 12% discount rate, this doesn't, the PDV of this project is negative, but at an 8% discount rate or a 6%, all of a sudden this is profitable, so I'll do it. So that's the idea, and the point is genuine, really productive seeming, they're building a factory or they're building a planetarium or whatever you want to call it.
Just by the tone of your voice, I can tell it's going to make money.
Yes, yeah. I mean, it's by God, right? It's usually like blue collar guys. They got big biceps. They drink beer. They don't drink like White Claw or something. They just drink beer. And so anyway, that's a productive thing. Got some steel in there and whatnot. All right. And the point is, no, it's unsustainable.
Yeah.
Right. It's malinvestment. Yep. That the interest rate was artificially low. The banks were lending out funds that were not corresponding to genuine household saving because of the whole, you can call it credit creation if you want. You don't have to call it fractional reserve banking, right? So there's a mismatch that businesses are starting a bunch of long-term projects for which there are not real physical resources that are necessary to get them all over the finish line. So it gives the appearance up front in the early stages of prosperity that a bunch of businesses are expanding and the diners and the movie theaters aren't laying people off because the consumers aren't saving more. So that's how that works. So that's why the unemployment rate drops. Everyone seems to be businesses brisk all around. But again, they're malinvesting things. There's not enough real resources to go around, and they're going to hit a wall eventually.
And
that is, what he's designating as the safe, productive way to engage in fraudulent bank credit creation. That's literally the textbook Austrian business cycle theory.
And your standard response by some statists is to put a band-aid on it by saying, but we'll just have regulators that can decide what the bad investment, the malinvestment is and what the good kind is. That's easy, but that's impossible, right? You can't do that.
Right. I mean, if you could, then you could have central planning. Like, why even have banks and, all this facade of money flowing around? Just have the central planners say, we're going to devote this much of labor and steel and whatever to building apartment complexes and this much to movie theaters.
One other complication that these egomaniacs who want to dictate how other people live their lives occurred to me said if you implemented this, the demand and therefore supply for loans to fund consumption and speculation even, that's not just going to disappear. It's going to get pushed into some kind of a black market. Do you have any kind of a insight as to, what the knock-on effects of that, how big you think it might be? You'd be charging higher interest rates because now you're committing a crime, so you got to mitigate that risk. But people are still going to want to take out the loans they wanted to take out. That's not
right.
That desire is not going to go away.
Yeah, I mean, there's that element. I don't know how you would quantify it. I guess it depends on how draconian the prohibitions are on the enforcement of the prohibitions are on such loans. Also, too, like fueling the asset purchases, too. It's some company is able to get a low interest rate loan to go build more factories. Well, surely that's going to push up the stock price of that company. Mm-hmm. You know what I mean? So again, like the idea that as long as the people aren't using the newly borrowed funds to go buy stock, and also money is fungible, right? So that if some company on its own was going to float bonds and then use the money to finance building a factory, but instead now they just go to the local bank and it just creates the money, marks it up in terms of a bookkeeping operation and then hands them the new money. Well, then the private households that before their savings would have been sucked up by the bond issuance of the company. Now that's freed up and they can go bid up stock prices with it. You get what I'm saying? So it's, I think you're right that it's in practice. I don't understand how you could possibly just say, "Oh yeah, we're cool with fractional reserve banking," but only into approved channels. That to me, that's goofy. That's like saying that it's fine if Russia exports its oil, but it can't go to these 7 countries over here. Like, there's no way you're gonna.
There's also there'd be just all manner of shenanigans to try and get around the regulations. Like, yeah, I know I can't buy real estate with this. That would just be speculation. But what we're doing is investing in solar farms by putting solar panels on the roofs of these houses that we bought.
Right.
We're renting them out, and we're hoping that the value of the land goes up. But no, this is a productive enterprise, not speculation. How are you going to regulate some?
Yeah.
Anyway, I only have one final question.
Okay.
And it's again because this guy just rubbed me all wrong. What in the world do you think he was talking about? Because he literally did say he thinks the CIA is out to get him. I don't think he was kidding. Like, I was doing my research over in Japan and everybody loved me there. I was, saying all these true things, but that's the other side of the world. But when I come back to the Western world and try to say these things, now they're trying to shut me up. Like, what?
Yeah, so the context there is, I think he was talking about his book, The Princes of the Yen. Mm-hmm. And so folks, he was saying it was a bestseller in Japan, and he was explaining. I haven't read the book, but just looking at summaries of it and what he was saying on Tucker, I think he was explaining like the problems in Japan, and they had their banking crisis and whatnot, and what happened with real estate prices and things like that, and so he was telling some version of the story that he was telling here. That we've summarized here. And also, too, I think he had, part of the specifics was that he thought like the Fed somehow instructed the Bank of Japan to allow this, economic malaise to linger and so on, right? And so he was saying that he would get people that were interested in the story, and then all of a sudden they wouldn't run, like they'd have a nice, interview with him and all sorts of glossy photos and whatever, long multi-page treatment. And then right before it was going to go to press, it would get quashed, and he wouldn't know, and the editor would be all embarrassed. And then and he was tracing it all the way up to the Bank of Japan, was against it and like, don't run the story. So he was saying he was getting those senses even in Japan. And then, coming to the U.S., you have an English version, publisher on board, everything's great, have a great lunch meeting. And then all of a sudden, we decided to pass. And so it seemed like behind the scenes, someone was doing it. And then the culmination of this is he said, was he back in Japan when this happened? I think he said somebody from the U.S. government flew to Japan and told him the CIA is watching you. So, he was not making a joke. And then, again, the fact that that's his worldview, was confirmed for me when he said that I and Jonathan Newman and George Selgin were controlled opposition, and that MMT itself, at least the modern popularity of it, is fueled by George Soros, which so far, maybe. But then to say, because George Soros wants to contain the fallout from Richard Werner's work is like, no, I don't think that's what's going on there. So that's what he was claiming. I mean, I'm sure he made some specific claims in The Princes of the Yen that were embarrassing to certain people. And I could totally imagine, just like, this Richard Aguilar guy that came out, Tony Aguilar guy, Anthony, that's what I was thinking.
Yeah.
And right when he comes out on Tucker and, former Green Beret and all that stuff, and a bunch of hit pieces all came out on him 2 days later.
True.
Which may or may not be true. One of them on my show, folks, we totally debunked, but other stuff is still up in the air as far as I know that it could be true. Who knows? So I can believe all that stuff, but again, this idea that, again, as we've documented here, Adam, that Ben Bernanke and Diamond and Dybvig won the Nobel Prize for their work on how banking interacts with causing the business cycle like 3 years ago. So the way he was presenting himself on Tucker, that there is this closely guarded secret that he alone is doing, his best to expose, and the system's out to get him. I think that's largely just self-aggrandizement. Is that the word I want?
It is. I don't know if you pronounced it right, but that's definitely the word. It just made me laugh when he said all that, because, we're libertarian weirdos and we think all sorts of crazy things. Heck, you and I are bomb-throwing anarchists. I mean, only I have a bomb. You're a pacifist. But when he's talking about that, I'm just thinking, oh, you've got feds watching you that are out to get you. Welcome to the party, pal.
Yeah. What's funny, I remember when I was in grad school, there was a period where I was really losing it for various reasons. There was a lot going on emotionally in my life with that. And I used to think that, there were guys, if they were smart, they would know what a threat I am. And then the older I got, I realized, number one, I don't think they're that smart. But number two is they realize, no, Bob, you're not a threat because all you do is say arguments and things and nobody cares,
Yeah, exactly. Anything else you'd like to say on this subject?
Just to round it out. So I think we did a good job of explaining how banks can create money in a way that Tesla or General Motors can't. But the second part of that, when the Fed makes a loan to somebody, or a more typical way is when they buy assets and just write a check on themselves, that money that is so thereby created is legal tender money. It's lawful money, right? It's equivalent to them just printing up $100 bills and buying stuff that way. Or Bob goes to the Fed, or Citibank goes to the Fed and says, hey, we're short, we want to borrow $100,000. The Fed can effectively literally just print up $100,000 in currency and hand it to them. Citibank cannot create money in that sense, right? Citibank can say, yes, here you go. You have an IOU from us for $100,000. Go, you can spend it in the community. And so that's maybe the way of seeing it, that a $100 bill, meaning a Federal Reserve note of Benjamin Franklin, means a certain thing to everybody in our country. Someone saying, oh, I have a debit card that Citibank says I have $100 on deposit, let me swipe that in your thing, that means something to people. And then someone holding up a bond from Tesla saying, oh, yes, Tesla owes me $100 next Wednesday when this matures, that also means something. But those three things are different. And so that's kind of the way I would rank it.
Very nice. Thank you. And I will just close out by suggesting that if you, dear listener, are part of any kind of a business or a school or a church or a club that you want to thrive and prosper, go over to theswanbrothers.com/cross and just put in your contact information. Some smart person who knows how to make great merch will contact you and tell you about all the ways that they can make you so glad that you did. Thank you so much, Bob, for this. This was edifying. And thank you, ladies and gentlemen. We'll see you next week.
So long, folks.